Ladies and gentlemen, I know that you, like I, often wonder what would a baby look like if the 2013 yield curve met the 2018 yield curve? What kind of baby would they create? This is the question that Jeff Snider answered in a recent blog post, the head of global research and what, genetic studies of yield curves, Jeff? Jeff, is that
Yeah,
also your
I think that's on everybody's mind, right? It's what if eel curds have babies? What would they look like? I'm sure that's a thought that's run across everybody's mind at one time or another. And yes, I tried to answer that question.
You do answer that question at the end of your article, at the very end. The article is called The Curve is Missing Something Big. It was posted on the 19th of October, 2021 at Alhambra Investments. The reason it was answered at the very end of the article is because you said, but before we can answer that question, we have to first understand what a yield curve does. And then you said, before we even do that, some recent housekeeping at the front of the curve where Bill lives. Holy wow. Okay. So let us do the bills first, and then what do yield curves mean? And then we'll answer the question about babies and treasury markets. Terrible. Terrible.
Yeah, we're getting off of topic here. I think we're going way too far afield. So yeah, the bills, housekeeping, more bills, treasury management, cash management bills are coming. We talked about this in the previous segment, which is October 13th, October 19th. The Treasury Department is going to start selling cash management bills again after having eliminated most of them starting in the summertime. So there's a little bit loosening of collateral constraints over the recent short run. We'll see how long that continues. But the purpose in going over that is to say we're taught to believe that the short-term interest rates are completely exclusively the purview of the Federal Reserve and monetary policy, when that's not the case. As we've talked about, the relationship between Treasury bill rates and the reverse repo rate, for example. We've talked about IOER in the past. In other words, that even in the short run, where the Fed is supposed to be, it's got its thumb on everything. It's really not the case. It's a little bit more complicated than that. Then expanding upon that, what happens when we get further down the yield curve into some of the middle and outer maturities in treasuries and even just debt in particular, which again we're taught that the Federal Reserve is controlling all interest rates when they're not really controlling all the short-term interest rates. What's really going on in longer-term bond yield?
The curve is missing something big. That's the mystery we're trying to solve. What is missing? The case of the missing what? Risk appetite. That's the other thing, Jeff. Yes, the Treasury Department says we're going to create some more Treasury bills for all of you. Guess what? Now it's the money dealers' turn to remultiply, repledge, intermediate this throughout the system. Okay, they may do so for the next few months until December when the next debt ceiling deadline comes up. But what is their perception of the long term, the medium term of the economy, the monetary order? Will they continue to exhibit the kind of enthusiasm maybe that we've seen over the last few weeks? We're going to answer that at the end. But first, let's talk about the yield curve itself. And so you want to teach us the short end, the medium, and then the long term. And then you have a very lovely graph here, a gradient graph that shows just the short, medium, and long term, and how it's money alternatives versus what at the long end.
Yeah, and I think that this is a major problem because number one, first of all, the public by and large only pays attention to the yield curve on very certain occasions when it inverts, like August of 2019, for example. And it's really, they're left with the impression that's the only time you should pay attention to the yield curve as some kind of recession signal. And if it's not that recession inversion signal, who cares, right? I mean, it's all the Federal Reserve stuff. And that's just the wrong way to approach this because there's a wealth of information in the yield curve that oftentimes has nothing to do with recession or not. Again, it's as you just said, Emil, are dealers taking on risk appetites that would move them and push them to intermediate not just collateral, but just general money flows all over the world. And so the yield curve is a one way that these money dealers themselves are telling us what they're doing, what their risk appetite is. And so in addition to yield curve inversion and things like that, you should always pay attention to the yield curve all the time because there's all these sorts of nuggets of information, very useful and accurate information that are available to the public in real time. Again, dealers are telling us what they're doing. So that's number one. And number two, when you look at the yield curve, what we're taught in school and what's reinforced throughout the financial media throughout the rest of your life is that, again, this is all just the Fed. Don't worry about this stuff. The Fed controls interest rates. In fact, that's what Alan Greenspan had said in 2005 during his infamous conundrum testimony to Congress. He said, look, the yield curve is nothing more than a series of one-year forwards. So we as the Federal Reserve set the first 1 year forward at the short run, and all the rest just kind of fall in line. So if we start raising rates and become more hawkish, what we then expect to happen is that the long-term end of the curve just goes up in step with that first short-term rate, a series of 1 year forwards. But in 2005, and other episodes for history, but famously in 2005, that wasn't happening. In fact, ever since 2005, in a lot of these periods, the bond market and the yield curve have portrayed Greenspan's conundrum, which is that, no, that's not how it works. The yield curve is not a series of 1 year forwards. It's actually, especially when you get into the middle of it, it's a blending of often contrary indications and factors that create sort of these twists and turns in the curve, which is what we're really talking about here in this episode, is looking at these various twists and turns and using them as useful indications of what's going on in the marketplace.
These twists and turns, they represent the real economy, right? Alternatives. At the front, we've got money alternatives. The Fed offers some sort of rates, and short-term US Treasury yields are an alternative to that. So you have to balance what the Fed offers and money markets offer versus these US Treasury short-term yields very well. But then as you get out further, the twists and turns represent economic opportunity, investment potential. And so that conundrum that we saw in 2005, 6-ish was the market saying, yeah, you're raising rates. We're worried. We're worried about what we see not too far ahead. And if I remember, housing prices peaked in 2006, and people were taking shelter in US Treasury, long-term liquid US Treasury bonds, because they were worried. The balance of probabilities was suggesting trouble. You give another example, historical example, the Taper Tantrum. And we got a graph here. Oh, I guess, so we've got a graph here of the yield curve when we're looking at the spread between the 10-year and the 5-year. You also show the 10-year and the 2-year. Why these particular tenors, Jeff?
Well, as you said before, breaking down the yield curve by segment, you see in the front short term, it's more influenced by money alternatives and money rates and money factors, but, not just today, but in the near term future. The market's saying, okay, rates are going to be X today, they're going to be maybe Y tomorrow, and that kind of influences more the short run. So if we start at the 2 year Treasury, that's sort of closer to the front end, which is a sort of, okay, what do we think of as what's the monetary conditions going to be? What are they going to do as far as interest rates go in the near term? Then the further down your curve you go, as you just said, Emil, we start to get into more inflation and growth expectations. So that by the time you get to the 7 and 10 year, it's almost exclusively inflation and growth expectations. So one way you can interpret the yield curve twists and turns is that the long end sort of looks at the front end and says, okay, we think this is going on, and this is how it's going to work out in the future. So in 2013, there was no taper tantrum, just like there was never a conundrum. When we interpret the yield curve properly, what we see is that the yield curve said long-term interest rates started to sell off, but they sold off more than short-term rates were, which was the market saying, we like what's going on in the front end, or at least we're not as pessimistic about the front end, the current monetary condition as we used to be. And we think that because things look like a little better in money conditions, that there might be a little bit more growth and inflation potential down the road. And so that's the yield curve steepening as the long end, which focuses more on risk return characteristics of inflation and growth down the road. That became more optimistic because of what was going on in the short end. The yield curve, you see more selling at the long end than the short end, which means the yield curve steepens, which is exactly what we want to see. That was not a taper tantrum. It was the market saying, hey, Ben Bernanke, we actually kind of agree with you for maybe the first time in a long time. We're thinking that maybe this QE stuff, maybe it did work. Maybe it had if it didn't work, maybe the chances of it working are a little bit better than they were certainly a couple months ago. So it wasn't a tantrum, it was a curve steepening, which is a positive, optimistic take on the current situation.
That's right. Forgive me for not putting scare quotes around tantrum. It was a taper celebration. Bernanke said, we're going to do QE forever. And then a few months later, no, you know what? Things are looking better. It was a celebration. Why would you own US Treasuries? If the economy is going to improve, let's get back out there and invest in the real economy and make some real money, not buy safe assets. Another misconception, Jeff, that is still with us is that this was a policy error, right? They raised rates too fast. They didn't warn the market in time. The Fed is at the center, and that's what causes this tantrum. Can you tell us about this second misconception about a policy error?
Yeah, since we're all told that the Federal Reserve, basically everything runs through the Fed, so the Fed creates both the successes and its own failures in this model because it's always the Fed about everything. Well, that's, of course, not really the case. So what actually happened, I love the way taper celebration. That's really, I think that's the right way to think about it. And that's really how 2013 should be thought of. It was a taper celebration. Unfortunately, it was very short-lived. In Eurodollar futures, it only lasted 4 months. And even in the Treasury curve, the steepening only lasted about 7 months, which is an incredibly short period of time when interest rates are incredibly low to begin with. So the taper celebrations were short-lived because the market started, as soon as we got to 2014, the market started to say, ooh, maybe not. Maybe we were getting a little bit too ahead of ourselves, too premature in a celebration, because we're starting to see more warning signs than positive signs. So again, translating the short-run monetary conditions through the prism of economic and growth expectations, you started to see more buying in the long end, even as short-term rates were still rising a little bit in the 2-year, and the 5-year Treasury rates sort of stopped rising and didn't fall either. So from 2014 forward, the yield curve started to flatten, which was an ominous sign of rising deflationary potential. The market saying, we're actually becoming less positive about growth and inflation, even at the same time as the Federal Reserve was becoming more confident in its hawkishness, its tapering and then terminating QE and then rate hikes that were supposed to begin in 2015. So the market, the yield curve was twisting and turning, saying, yeah, we think the Fed is going to remain hawkish, but we also believe that the marketplace, the actual economy, economic conditions, growth and inflation are not what the Fed thinks it is at all. And so that flattened the curve. And what a lot of people then say is, well, that's just the Fed tightened too soon. And that is a policy error. They should have let QE run farther. They should have gone, they should have waited on rate hikes. They should have changed their Delphic forward guidance to more Odyssean forward guidance and all this nonsense, which is
Jeff,
really,
tell us,
it gets into this mess about what monetary policy actually is. And it's really about no money. It's all about expectations. But what the market was saying is essentially the flattening curve of 2014 was, the Fed is wrong. The Fed is becoming hawkish. Not that it matters that the Fed is hawkish, but the Fed is becoming, the higher short-term rate potential for reasons that have nothing to do with reality. And that's the flattening the curve, the ominous signal that the Fed is making a mistake. It's a mistake of prediction, not one of policy.
That's right. I was thinking of when did they actually raise rates? 2015, right? Once?
Yeah,
and then once again.
Was the first one.
That was too soon, Jeff. Too soon.
One interest rate hike spoiled everything, right? It's a ridiculous, and that's after 7 years of a zero interest rate policy. So we obviously needed a couple more years of accommodative policy. I mean, at some point you just have to laugh at how absurd all this stuff is. But that's why you pay attention to these market signals. You don't pay attention to the yield curve only when it inverts. You pay attention to the yield curve all the time, because it has all of this information. So from the first day of trading in 2014, the yield curve was telling you the Fed was making a mistake. Deflationary potential, not inflation, was rising. The economy was falling off. There was a greater chance of a dollar problem arising than there was of recovery. And by the way, that was what actually happened. The yield curve, rather than the Fed's models, the yield curve is a much better predictor of the way things are going to go, especially as it relates to growth and inflation. So if the yield curve starts to flatten out, even if short-term rates start to rise in anticipation of the Federal Reserve's actions, that's not a conundrum. It's the bond market saying, we see the Fed going to do what it's going to do, but we think they're absolutely wrong. Again, the only reason you call it a conundrum is if you believe the Fed is infallible.
Okay, May 2013, Bernanke, taper. It wasn't a taper tantrum, it was a taper celebration. the markets through a ticker tape parade, move forward 8 years, the markets once again through a ticker tape parade. But Jeff, and people will say, yeah, because of the taper. No, as these graphs show, now we're looking again at the spread, 10-year, 5-year, 10-year to the 2-year. The celebration, the ticker tape parade occurred for the reopening, the end of the COVIDs, right? And then well, kind of the end, whatever. I don't even know what epsilon version we are on the variance, but the celebration did take place, and we can see it. The spreads widened just like before, and then they stopped widening. I guess that's the point of your article, Jeff, is the taper's been announced. Is the yield curve steepening now, celebrating as we dive nude into the pool, yelling cannonball, economy? No.
Yes, celebration was January, February, and into March, right? That's when the yield curve steepened again like it had during the taper celebration of 2013. That was the market saying, there's vaccines, there's possibly an end to the pandemic, there's all this Uncle Sam deposits going around, stimulus, whatever you want to call it, all of these really wonderful things. Maybe, just maybe, there's a small chance, a better chance, that the awfulness of the past year or the past 12 years, maybe those are behind us, and we're actually moving into a much, well, not a much better, but a slightly better chance of inflation and growth down the road. That was the steepening yield curve. That was nominal rates rising. But as you said, Emil, something changed, and it changed in the middle of March. And ever since then, first nominal rates started to fall back again, which caught people completely off guard because they're thinking inflation is only going to get worse, not lower. And then since August, nominal rates have been rising again, but not in the same way at all as they had been doing earlier in the year. Nominal rates going up now is all about stuff at the short end, whereas nominal rates going up during that reflationary period early in the year were all about the long end, steepening, growth and inflation expectations. And so what has changed since March through both first lower yields and now slightly rising yields again, retracing yields again, is that ever since March, the yield curve has flattened. It has continued to flatten as interest rates have risen since August, because it's exactly the same kind of situation as 2014, where the market is saying, yes, we see that Jay Powell is going to taper QE and maybe even get to some rate hikes. The Fed is becoming more hawkish, which will have a rising influence on the shorter end. But we disagree that the reasons for the Fed becoming hawkish. We don't think the economy is improving. In fact, we think there's rising deflationary dangers, growth scare, global slowdown, as well as T-bill problems, monetary factors, dealer risk aversion, any number of things. So the long end of the yield curve is saying, we don't agree with why the Fed is being hawkish, even as we acknowledge the Fed is becoming hawkish. And so it becomes a very eerily similar situation to not just 2014, but also 2018, when the Fed actually was raising rates, and the yield curve behaved in exactly the same way. Nominal yields rose at the 10-year and the 5-year, but they got squeezed. Those calendar spreads got squeezed. The yield curve flattened, which was a signal throughout 2018 that told you not inflation, not growth, not acceleration, not an abundance of actual effective money. In fact, the opposite of all of those things. So to see those things developed from March of 2021 forward and continue as nominal rates are rising during this quote unquote taper period, we're back to it's not the tantrum that everybody thought in 2013. It's certainly not the taper celebration, which would have been a more accurate term. It's a taper something else, a taper rejection, I guess. I don't know. Maybe you can come up with a better term.
Well, we don't have to, because David Parkins illustrated for us Mr. Jay Powell in a beautiful limousine going down the canyons of Wall Street celebrating the taper. And then we see a single piece of taper bouncing off his head in the form of a toilet roll. Thank you very much, David Parkins. Jeff, we're going to answer the question at the beginning of your article now, and that is about baby making, of course. A lot of people don't know this, but fertility rates were rising across a number of advanced economies heading into 2008. People think, that was actually on a continuous downtrend. Not true. It was rising, depending on the country, for many, many years. 2008 happens. No, starts falling, and it has never recovered since 2008. I think it's people voting, importantly, about the state of the global economy, no matter what they hear in the media. Same thing happened with 2021. All the lockdowns, there were expectations from experts that there would be a mini baby boom. Guess what? Absolutely not. Why? We know why. It's lousy out there. Lousy. Uncertainty is so high after so many years. All right, that's my very depressing lead-in to a very happy baby making, where you ask, what would happen if 2013 yield curve met 2018 yield curve? What would they produce?
It would produce the demon spawn that is the 2021 yield curve.
Yes.
Which is, look, if inflation and growth and everything was if everything was positive and things were moving in the right direction, even modestly in the right direction, we would not see the curve flattening as we have consistently, whether nominal rates are rising or falling since March. So what is that? Almost 10 months of this, which I think is a pretty conclusive, non-random sample that says the market is telling you in the yield curve pretty much the background that you need to know about what's actually happening this year, which is not the inflationary theme that the mainstream media has run away with. It's actually growing concern, angst, and, as to your point, on the ground conditions that are not conducive to anything good going forward.
We're going to talk about stagflation, inflation, superinflation, the great inflation of the 1970s. Jeff, you wrote an article about a week ago at Real Clear Markets about Richard Nixon, secret tapes, meetings with the Federal Reserve Chairman and the budget manager of the the Office of the Management of the Budgets of Money of something. It's on tape. You wrote about it. We're going to talk about what we heard and whether or not we can learn anything from the great inflation of the 1970s to present day.